to the back sapphire crystal and the digital crown.
Thanks for tuning in to the Mutual Fund Show. My name is Neeraj Shah, and today what we're going to do is try and tell you how to navigate through the uncertain times in the equity markets. Actually, well, you can extend this argument even to the debt markets, but how to navigate through uncertainty and how to take stock of how does your mutual fund portfolio look like and how can that portfolio weather the storm. Now, small data point out here, and just want to bring that up. These are the various time frames wherein we've seen some percentage changes predominantly in the Nifty. Now, we've started this count from 1992 or thereabouts, and that period wherein we saw the Nifty move up about 158%. Now, remember, currently you might scoff at, but back then when the markets were not so volatile, this was not chop change. This was a fairly steep rise on the index, and then we had a course correction for a couple of years. So 2000 to 2002, the Nifty did correct about 31%. Post that, a rise of 457%. This was the period from 2003 to 2007, the golden period, which I think almost everybody else remembers as the one which had a massive rally. Post that, 2008 to 2011, the recent Great Depression, if I can call it that, there was a sharp correction out there, and then there's a percentage gain, then some losses, and currently sitting at some percentage gains as well. The whole idea of showing these numbers, or broadly these trends, don't get hooked onto the specific numbers, but broadly showing these trends is that following every good period or following every crest would be a trough, and every trough at some point of time will be followed with subsequent peaks that will come about, and therefore don't get disheartened by some losses that are there in your portfolios. The whole advertisement or the whole promotion by Amphi around mutual fund sahi hai but patience zaruri hai might have some merit, but you might find more merit in listening into two people who do this day in, day out for a living, which is look at mutual funds, manage mutual funds, sell mutual funds. So two experts to talk about how could you as an investor weather this storm. Radhika Gupta, CEO of Edelweiss Asset Management, as well as Harshad Patwardhan, Chief Investment Officer of Equities, Edelweiss Asset Management. Both of you, thank you so much for joining in. Harshad, you understand it was really important to have you today because of the mayhem, if I can call it that is there in the markets. But this whole conversation, Radhika, let me start off with you. Around people suddenly turning skeptical about not just their stock investments. I can understand that's happened a number of times in the past, but mutual fund investments as well. Just when we've spent the last 2 years telling people, then don't get worried, stay invested for the long term.
So mutual funds continue to be sahi hai. I think, that thesis may have been questioned over the last 1-2 months, but I don't think 1-2 months has ever defined a thesis. I think Harshad and I were chatting. One of the challenges, of course, is that many investors have come into mutual funds very honestly in the last year and a half. They are new investors, and for them, this may be their first correction that they're seeing. It's the first time you've seen your portfolios down. And honestly, 2017 is not reality. I mean, it spoilt us a little bit, right? It was a year when markets were up and away. 18 is actually the reality of equity markets. Mid caps underperform large caps. Things are volatile. You have 30-40% corrections in single stocks. This is reality, and in some sense, it's good you're experiencing reality. I mean, the only thing I'd say, and I'm sure Harshad will talk about this more, is that if you look at anything on a daily basis or a yearly basis, it is bound to be volatile. Things could be up 50, they could be down 50. But as your lens becomes 5 years, which is what you really invest for, your gains are much more capped, your losses are even more capped. So your worst case outcome over 5 years is probably 1-2%. Which is what you went in for. So you just have to broaden the time horizon and step back a little bit from the chaos.
Yeah, and I think a lot of people might say, hey, that's easier said than done. I've seen my NAV come down 5, 10, 15, 20%. What do these guys know when they're talking about this? And we'll talk about not just the equity funds, but all over the funds as well.
Yeah, absolutely.
Yeah, but Harshad, come in on this. You've obviously seen a bunch of these cycles. People are getting perturbed. This is probably not as bad as 2008 was. We haven't seen it go as bad as 2008, and
Correct.
Therefore it's important to drive home the message that what we're seeing right now could well be the trailer. The picture could actually still be remaining.
Okay. No, that's one way of looking at it. But it's always, when the emotions run very, very high, it's always good to go back to statistics, just to put things in perspective. If you look at 38 years of history of Sensex returns, I'm taking right from 1980, when it started, 28 out of 38 years, that's roughly 4 out of 5 times, Sensex has delivered positive returns. It's very, very important to put that in perspective. And as a result of that, when we look at long-term returns, we get that 16% number. Okay, so it's in the nature, as Radhika was rightly saying, 2017 was a market of very, very low volatility, right? It was just one way up. What you are seeing now is probably more normal times. And we have seen this, many, many years over the past decade or 2 decades. So this is not something to be unnerved about. It's in the nature of equities. Volatility is in the nature of equities. You just have to, hold on and not panic.
Yeah.
I think that is very, very important at this stage of the market.
Yeah, there's a study that you guys have done, which is, of course, showing this as well, that volatility, while comes in with a bang, it reduces if you stay invested over a period of time. Either you want to comment on that?
No, I agree. And, the truth is none of us invest for 1 year. None of us invest for 6 months. And certainly none of us invest for 1 month. I mean, all this conversation that we're having, if we were doing the show a month ago, we probably would have been doing it with a very different tone. Think about it. 3 weeks has changed our sentiment so much. But do we invest for 3 weeks? Not really. When you do SIPs, many investors are SIP investors. When you do equity investments, 5 years, 7 years, we've talked about this on this
multiple
show.
times, yeah.
It's just that our time horizon, when we start looking at our day-to-day NAVs, automatically becomes a lot shorter. The other thing I would say, and I'm saying this on a news channel, is that people should not react to information in their portfolio. So at a time like this, and both of us have lived through 2008, you will open the screen and a stock will be down 20%. It could be down 20% for the right reasons. It could be down 20% for the wrong reasons. Some random regulatory rumor, nothing is wrong with the underlying business. Does that mean you should go see your mutual fund portfolio, see how much of this stock I own, and start getting worried? Definitely not.
Yeah, viewers, I think it's also important to put this into perspective. If you are an informed mutual fund investor, wherein you know what the portfolios have and you've researched them and you're getting into it, then it might still be okay for you to think about whether or not I should get out of this fund and maybe invest into some other funds. But for a large proportion of us, me included, who invest into funds based on the basis of what a financial advisor has said, or trust a fund manager to do with it, trust me, the fund manager is more worried when the stock is down 20% than you or me are. So leave the worries on the fund manager, just stick the course, and that might probably be more important.
And
but
Neeraj, if I can add one quick point.
Sure.
Remember, mutual fund investors, the best part of mutual funds is that they are diversified instruments.
True.
Most of the portfolios are 40, 50 stock portfolios. When Harshad builds a portfolio, he's looking at diversifying across sectors, size caps, the whole range. So it's never about single stock performance.
Yeah.
The reason you do mutual funds is so that you don't have to worry about this.
Yeah, true. But this point, and you want Harshad to come in on this as well, the volatility chart, if we can get that up on the screen or on the wall, and then I'll get in Jayesh as well for a very interesting piece. But this is the market volatility chart, and it clearly shows that if you stay invested for the longer term, the returns are strong, the volatility reduces. In a sense, you can say that volatility becomes your friend, Harshad, because in volatile times, you're actually able to buy more units of a mutual fund, strictly from a mutual fund investor's perspective, more units, and that might only hold you in good stead later on.
Absolutely. So it is good for mutual fund investors, because if you have done an SIP, you absolutely end up doing that. It also helps for the fund managers. So at this point of time, there were many stocks which I liked, businesses which I liked, but I didn't buy because the valuations were a little too high for my comfort. Many of those stocks are now available because some of them are down 30-35%. So volatility is not just good for the mutual fund investors, it's also good for the fund managers.
So interesting. Okay, here's some data. Here's some hard data. Jayesh Khilnani has put together some names. So just like the equity indices, mutual fund schemes to see some drawdowns over periods. In most cases, they would recover smartly as well if the fund is managed well and they make money for investors. So as I was saying, Jayesh has put together some data points to try and show you some schemes or some examples which have done precisely that. Jayesh.
So Neeraj, before we go on to the names, I just wanted to highlight how I've arrived at these three names is based on the total assets that they have to be, on the larger side, and the fund should have had history before the year 2000 which gives you a reasonable 20-25 year data point to look at. So what we did was, if we can have the first fund, which is the HDFC India Equity Fund. Now you can see what this actually shows you is the maximum drawdown that the fund has seen in the last 20 years, and what you will see during the 2008 period is that it declined for 14 straight months and gave you negative return of 56 months. But on the way back, it has taken only 9 months to recover all of its losses. And 2008 is not the only period. You can have a look at the 2001 to 2002 period where the fund gave you negative return, but post that the NAV has started rising again. So this is normal phenomenon when it comes to the NAVs or the markets that we have. So this is one of the examples. The second example also will reflect similar kind of picture, which is the Franklin India Equity Fund. Now you can see once again in 2008, 14 months of decline that has given you negative return of more than 50%, and on the way back it has taken 18 months to recover. So a longish bit, but it has definitely recovered. And you can see that once again in 2000 to 2003. So these are also largely associated with the market cycles as well. But eventually you see, if you had stayed the course of the entire 20-22 years, you would have made decent amount of money, because the NAV from double digits has moved to now more than 600 or 572 at the current level. So that's the kind of return that people are looking at if you had invested through the course of the entire 20 years. Lastly, the last example that we have is the Aditya Birla Sun Life Equity Fund. Once again, the drawdown is close to about 52%, 14 months of decline, 18 months of recovery, and you can see once again these large red portions that I'm pointing out, 95 to 98, then again 2000 to 2003. These are the market cycles when the market actually went down, and so did the NAVs. But then you can see the recovery in excess of about 570 odd levels. That is what we have on the screen for you.
Hey Jayesh, thanks for putting that into perspective. So clear data out there and live examples of mutual fund schemes which have fallen only to recover smartly over the course of the next few years. Do you guys believe we are firmly in that period as well? Is this time different? That's the classic question that comes on everybody's mind. Harsh, you want to comment?
So my opinion is that for the next 6 to 9 months, things will probably remain volatile. Because if you look at the negative factors which are impacting the markets, let's look at domestic. Domestic politics is a big question mark. What will happen in May 2019, right? Which is why I'm saying probably 6 to 9 months. Internationally, oil prices are rising. As you know, they have probably crossed 85 now. And when the oil prices are high, there are no good options for India from a macro perspective. In addition to that, there is a raging trade war between China and US, which seems to be escalating, and there may be collateral damage for the emerging markets. So I would say next 6 to 9 months is a time to be a little cautious, not panic, but be cautious. In the medium to long term, when we look at real long term and say that equities have delivered those kind of returns, if you actually analyze, equities have generally, through the cycle and over long term, have basically mirrored the earnings growth. Right? And it's very, very important to remember that we are coming out of a very, very lackluster earnings growth period. Just to give you a number, FY08 to FY18, the CAGR for Nifty companies, for example, was barely 5 to 6%. Right? From there, we are probably getting into a period where that number will be significantly higher, maybe in high teens. So when we are entering into a period of high earnings growth, next 6 to 9 months, if we can navigate well, I think medium to long term returns could be very, very good.
Well, let's hope for that. So then the question mark is, Radhika, that for the next 6 to 9 months, and for a lot of new investors, even 6 to 9 months might be a long period of time. Yeah. For the next 6 to 9 months, tough conditions, how to weather them? I mean, diversification, don't be afraid of losses. What are the things that you would recommend?
So I think there are three things. I think the meta point is that investors have to know why they're investing and what their goals are. But the best thing that can really help them is asset allocation. The good news is, and we've spoken about this on the show, the mutual fund industry has now given you enough tools to help you hedge against the volatility. SIP, as Harshad talked about, is the natural tool. It protects you against volatility. asset allocation, making sure that you have a balance of both equity and debt, and I know fixed income has had its challenges also, in your portfolio will help you. The third thing is dynamic asset allocation or balanced advantage funds, which do this for you. They take advantage of market volatility by deciding when to be in equity, when to be in debt, and do that shift. So you can take advantage. Even today, you can invest into MFs with a 3-year horizon or a 2-year horizon using some of these tools. If you're a little afraid of volatility, they'll help you mitigate this.
Well, also, I think the points that they've mentioned, just before I get to this diversification thing, do not follow the herd, do not invest based on personal feelings. I think that's really, really important. One classic mistake that I'm sure Harshad will agree with as well, that a lot of people look at the peak that a stock has touched and then a subsequent fall and say, acha, ye 500 wala agar abhi 100 ho gaya to sasta hai, let's go out and buy it. I don't think that's the right approach, right? Because that guy who's buying it at 100 doesn't quite know whether the value is 100 or whether it's 50 or whether it's 200.
Absolutely right. I think one shouldn't really go by the absolute stock price. One should look at valuations. Also, many people, for some reason, tend to look at trailing valuations. You know, I hear it so many times.
TTM, yeah.
Trailing valuations, in my view, make no sense. You have to look at, although your forecast may not be accurate, one has to look at the forward earnings and decide on the basis of valuations whether it's worth it or not.
Interesting. You're speaking about diversification and how there's a very interesting data point that you guys have given us as well through time frames. So 1998 to 2017, equity, debt, gold, and asset allocation and the difference in returns. If you can have that data on your screen. And Radhika, you may want to come in on this. What is it that we are trying to mention via this chart?
So I think it's a very interesting chart. I think it captures, when we talk about investing, we often talk about the return aspect of investing, and that's what you see when you see the CAGRs on that screen there, that the long-term return of equities, this is large cap indices, is 13%, fixed income is 9%. What we don't capture, however, is the second and third element, which is volatility or drawdown, which is what you're experiencing right now. So drawdown is the worst case loss you could have experienced while investing in equities. 55% is, of course, the 2008 number. Now, if you look at a portfolio, that's the one in the corner, which is your asset allocation portfolio, look at the return. It's nicely between equity and debt. Actually, it's closer to equity. But instead of a worst case outcome of 50%, your worst case outcome is actually closer to 20%. That's more palatable to a lot of investors. That's the power of diversification. So whether you do it via balanced advantage funds or whether you do it via asset allocation, just by controlling volatility, you'll keep your holding power longer. A lot of people may not be able to digest 50% red on their screen. They'll be able to digest, and that was 2008. This is not 2008. You may be able to digest 10, 12%. So you'll hold through the period. I think one of the things, unfortunately, that we've seen is that retail investors exit at the worst times and often enter at the worst time. Asset allocation takes care of that problem.
Yeah, should be interesting. And I believe, as in stocks, so in funds, the key should be to protect your downside, because if that is protected, then the upsides can be multifold, because you have not experienced that drawdown, that 50% drawdown that happens in certain cases.
See, at a portfolio level, it's important to protect your downside. There are different kinds of funds out there. At a portfolio level, you know, there's a great statistic that if you lose 10%, to come back, you need to make 11%. If you lose 50% of your portfolio, to come back, you need to actually make 100%. So it's a very, very powerful statistic. So not at a portfolio, remember, because if you're investing in a long-only mid-cap fund, for instance, it will follow the mid-cap index. Be rest assured. If mid-caps are down 50%, that fund may be down 40. If Harshad does a phenomenal job, it may be down 35, but it's not going to be up by any stretch of the imagination. That's not his mandate. But at a portfolio level, if you've got a little bit of mid-cap, a little bit of fixed income, a little bit of large cap, your outcome will be a lot cleaner.
Would you, Harshad, if you were to be investing your own money right now in funds, would you look at a large cap fund? Would you look at a multi-cap fund? Would you look at a mid-cap, small-cap fund? Because of the fact that the mid-caps and the small-cap indices have just fallen so much. What would be a prudent area to start an SIP? We're not talking about a lump sum investment right now.
So I think this is probably a very good time to look at mid-cap funds from an SIP perspective. Because as you rightly mentioned, they have underperformed quite significantly compared to large caps. Also, if you look at last 17 years, right, 11 out of 17, 10 out of 15, 4 out of 5. So basically the odds of mid caps doing well over long terms statistically are very, very high. Many mid caps are now available, getting to very, very interesting valuations. I will not say that in absolute sense they are no-brainers yet, but they are getting there. So this is a good time. Use this volatility to your advantage by doing an SIP in a good, high-quality, liquid mid-cap fund.
If you can stomach volatility,
yeah,
why not a lump sum investment and why an SIP?
That is because, frankly, I see these 3 things, 3 risks that I mentioned. So if you do lump sum, and for some reason, some untoward incident happens and the stock, market is down by 10%, what do you do?
Okay.
So it's prudent to do that. However, I will just add one thing here, that you might recall the second half of 2013. After taper tantrum, the market sold off, right? Emerging markets overall sold off, Indian market sold off. I recall that in recent memory, that was probably the best time for fund managers to buy stocks. Okay, many businesses which were perfectly in good conditions were available at valuations as if they were going out of business. Right?
Do you see that scene right now?
Not yet.
Not yet.
But we might get there. So what I would say is that start an SIP or an STP over the next 6 to 9 months, but keep some powder dry. If some incident happens because of which the valuations start looking very attractive, that is the time to be aggressive. So hold your nerves and put in money at that point of time, because you might recall again, I mean, we all show long-term averages, right, in stock returns. But people who did invest in second quarter of 2009 made lots of money. People who invested in third and fourth quarter of 2013 made lots of money. I think it's very important to highlight those aspects also.
Yeah, it is. But believe me, viewers, I just want to add a point out here. Don't think that what Harshad is saying, that if somebody invested in 2009 and made a lot of money, then therefore you should be looking for that period. It's very, very difficult to time that. Best fund managers can't do that, and which is why maybe an SIP is a better route. Since you can't time it, try and invest across time periods through an SIP or an STP. In some of your investments, you will manage to catch that bottom, and which could give phenomenal returns, and the consolidated numbers might be good. Radhika, Harshad, there is some data that you provided us today. We actually spoke about this a few days back as well. The divergence that has happened in the Nifty versus the small cap index, and how, according to our data, since calendar year 04, we haven't seen that divergence, maybe slightly longer than that as well. And maybe that points to one more point, Radhika, that there is fear, even though the large caps are not showing, mid caps are showing fear. But maybe that was good to know, good to have as well, because that's what the market is all about. It's not a risk-free market. Equities are not risk-free.
Exactly, and one of the things is that you have to look at the last year in context. It's a very, very special year, and I'm not making excuses as an MF industry. Large cap indices have done well, but even within the Nifty, 4 or 5 names have done well. The rest are not contributing to the Nifty performance. Mid caps and small caps are down, and this is after a period of 3-4 years when, frankly, the benchmark indices, the Nifty hasn't done very much, but mid and small caps have done far worse. So the index is not a fantastic comparison. But the fact that there is so much divergence between mid and large caps now, and who is to know whether 20% divergence or 25 is the bottom, as you said. Nobody can predict that. But it just tells you what a potential opportunity one could find in mid caps if you have the patience to ride out the next 6 to 12 months. And especially since we're sitting at the bottom of an reviving earnings growth cycle.
Interesting. Okay, the last question, and that is not necessarily only on equity funds, but the whole problem, Radhika, has been around, or maybe the catalyst for what's happened has been what's happened to debt funds as well, right? Now, how's the situation looking there? I don't know if Harshad has a view here, but if Harshad has, then that, or Radhika, you.
So I think what's happened to debt funds is no doubt challenging. There's been an instance, it's affected a number of mutual fund schemes. I would tell debt investors 2 things. One is that when you're investing in debt, it's not a place to be cute. You invest in debt for fixed income kind of returns. For that 1 to 2% extra, don't take chances, then go to equity, right? So be very careful about the portfolios that you're investing. Most retail investors are actually very happy doing low duration, short term, these kind of simple funds that don't take large credit risk, that don't take large duration risk. In respect to the events that happened, I will say this, and it's a little bit of a contra point of view. It has happened largely in a category of funds called credit risk, which take credit risk. there is risk in fixed income. Just like there is risk in equities, there is risk in fixed income, and we have to be prepared that if you invest in lower grade credit companies, defaults will happen. So that is also a reality. If you're not ready for that risk, just like if you're not ready for small cap risk, don't do it. Do large cap. If you're not ready for credit risk, there are a lot of there are arbitrage funds, there are short-term funds, there are low duration funds. There's a lot of stuff that's pretty simple and straight. Do that.
Okay, a lot of sound advice coming in from both our guests today on the Mutual Fund Show, and much needed as well. It's a bit of a scare out there, but nothing too alarming as yet. Thank you so much, both of you, for joining in today and giving us your thoughts on the Mutual Fund Show. And viewers, thanks for tuning in to this edition of the Mutual Fund Show.